could you kindly just mute your mics as you join? As you join, just please mute your mic so we have a quiet class. And but when at any point in time in this class, if you have a question, you can unmute and ask your question, right? So today we're looking at liquidity concepts, looking at liquidity. I think in the previous class, I explained a little bit on what liquidity is. I explained about what liquidity is. Talk about liquidity simply means money, right? Like I told you in the start of the class that the focus in this class is to get you up to speed so that you can start making money off the market, right? So some just ignore if I know some of you that are well read or read up, ignore if I don't use the exact terms, but just get the understanding of the concepts I'm trying to pass across, right? Because the forex space is quite broad, and this class, my focus on this class is to streamline and cut your learning curve to just give you what works, right? So you don't spend time learning everything, every jargon, every theory that you end up confusing yourself and you wallow in the dark looking for what works. So I'm giving you precisely what works. So that being said, I'm telling you that liquidity concept is basically what the market operates on. Like I told you in our previous classes, that the market is algorithmic, so it's programmed. It's programmed to work on specific time, and there are two things that the algo works based on. It works based on the price and it works based on time. So two things must harmonize to give the precise movement of price in the marketplace, which is time and price. So in this, now, when we talk about liquidity, like the word refers, it means that it's money, right? When there's money. And in our introductory class, our beginner class, I talked about forex being the most liquid market in the world right now, with over 6.3 trillion US dollars traded daily. That's to tell that there's money trading in it daily. That's why you can just wake up and go to your MT4 or MT5 or your trading station and you click you want to buy so quantity and it's executed. Why? Because there's a counter order available for you to execute your buy. For your buy to be executed, it means that there's an equal or even more orders of sell at that particular point, right? So now this is the concept in which the market works. That means for every buy you place in the marketplace, there's someone that is placing a sell, that is taking the sell order for that counter. I don't know if you understand that, but what it means is that let's say someone wants to buy maybe 10,000, or you want to buy 10,000 worth of a particular currency, let's say EU, right? By now, I think we should start getting familiar with the term. When I say EU, it means it's EUR/USD. That's Euro and USD pair, right? So you want to buy 10,000 units of EU. For you to buy at that particular price point, it means that there is someone that is willing to sell this 10,000. There's no someone that is willing to sell this same amount for you. If there's nobody, you have to wait, right? You see, like in normal buying and selling, sometimes you buy goods and there's no, you buy goods and you want to sell. When you want to sell, you don't find seller. You start advertising who is going to buy, who is going to buy. It's not like that in the market. The market is liquid. So for you to execute this buy order, there must be the opposite of the sell order, that someone is taking this amount of the asset off you, right? So that was basically the concept of liquidity. It means that there's money in the marketplace. So in summary, we'll say liquidity is where the orders are resting, your orders in the market, right? Your buy orders, your sell orders, your stop loss orders, that's liquidity in the market, right? So if we have, let's just take this diagram for instance. Liquidity is everywhere in the market. So here at this point, there's liquidity. At this point, there's liquidity. At this point, there's liquidity because there are stop losses, orders, there are pending orders there. So liquidity is everywhere in the market, right? So if you're looking at, there are several things to look at. It's just the money being available for you to trade those assets easily available. Now there are some things that as you start trading, you get to understand things like slippage. There's what we call slippage in the marketplace, right? Now slippage normally happen when there's high volatility or news in the marketplace. What it means is that you will execute at a particular price point, but because the market is highly volatile, it's moving so rapidly, you might not necessarily get that exact price point you are requesting to buy or you are requesting to sell in. And this basically happens during news time. It happens during news. So when there's news, you know that you will not get filled at the exact price you want, because before the market goes so volatile so rapidly, before they find a seller for you to sell when you want to buy, or someone to buy when you want to sell, there'll be a little gap. That's what we call slippage, and that's why I would advise you to stay off news, right? That's the disciplined way of trading, is to stay off news, because news is very highly volatile period that you cannot predict price. Yes, true. The markets are programmed. There's an algo running the market which is precise, but that algo normally manipulates a lot during news, right? Because during news, the algo is seeking liquidity. Yes, you can be right in the direction of the market, but you might just be liquidity that will be taken out before price moves in that direction. So you can never tell. You can never 100% for sure tell that price is just going to respect a zone and just take off during news. Yes, we have some people that trade news. They call them fundamental traders. They trade news and they say that, yes, based on what happened in the past, it can happen. Yes, I think last year, I knew someone that used to trade CPI a lot, and I could, based on my research, I could see that CPI always just takes off from one level, but the algo was smart enough to understand that people always know that CPI takes off. Then I think from, was this August or September, CPI starts with soaring. So even if price was going to go in the up direction, price will first of all go down, clear all the people's orders, their stop losses, or go up again, clear all these people before going in a particular direction. And you see it happens in major news like NFP, CPIs, FOMCs. This happens. So that's why it's always advised to stay off news trading. Now, that being said, the main thing we're talking about liquidity, right? So there are types of liquidity you find in the marketplace. There are several types. I like to classify liquidity into two classes of liquidity. I like to classify it into what I call, there's a time-based liquidity and also there's a price-based liquidity, right? But for the purpose of this class, I'll just put everything under one class and call them types of liquidity, right? So I'm going to be looking at types of liquidity. So briefly, I'll use diagrammatic annotations, then we'll jump into the chart. So I'll show you what I mean by that. So in summary, if you're asked what is liquidity, liquidity is just where the orders, the stop orders or the stop loss or the pending orders are resting in the marketplace. So in layman's term, it's money. It's where money is resting. So like I explained in the diagram, money is resting in several points, several major points, right, in the marketplace. So money is resting here. What I mean by money is resting, stop loss is here, right? That is money resting. Here you can have pending order and stop loss. People that want to trade breakout, they have pending orders, and when they put their pending order, they will definitely have where they'll put the stop loss. That's money. So liquidity is everywhere in the marketplace. It's money in the marketplace. Is that understood? If that is understood, we are safe to move further to look at the several types of liquidity we have, right? So I'm going to be focusing on how I combine these liquidity concepts in trading. I don't just want to bore you with several jargons and stuff, just to get a basic idea and how to combine it when we start looking at our analysis, our high time frame analysis, and putting everything together from beginning to trade execution. So number one is ERL, right? Now I put them in abbreviation for a purpose, so you start getting used to it. So this is what is called external range liquidity. Now, basically, this is liquidity that is resting at highs in the marketplace, at maybe turning points, lows and highs in the marketplace, basically. Now, what do I mean by that? Right? So if you have price movement like this, like this, like this, so the liquidity resting at this point, at this high point, maybe an old high, a old low, or a structural low or structural high, those are what we call external range liquidity. Now, external range liquidity are divided into different types of liquidity. We have the equal highs, in which we equal highs that we call this is how it's abbreviated. We have the equal lows. Then we have the relative equal highs and the relative equal lows, right? So these are the class of external range liquidity. Now let me explain. I'll explain each and every one of these so we understand briefly before we go into the chart. Please, if I'm fast, you can just slow me down if you don't understand anything, because I know we have to go into the chart. So our time, we have limited time. So that's why I'm trying to catch up, pick up pace. Right? So now equal high. Now you have equal high, what retail traders call double top, like this. Now this point, sorry, just ignore that. So this point, these are what we call equal highs. So these highs are, they are equal. So these are equal highs, right? So at this point, you see money is resting here. Now, they are basic trader. We have people call resistance, support and resistance trader, right? The concept of resistance means that when price is going up, it meets a resistance, so it cannot break that level. It comes down, it goes, it meets, right? So now there are many traders that will say, oh, now it met this place first time, second time, now it's resistant. That means if price comes here again, it's going to crash. So people will position to sell at this point here. They will position to sell at the top here, at this equal low. That's where they want to sell. And when they want to sell, they'll put their stop losses, right? So I told you the concept. Now, price, based on liquidity concept, price will always want to hunt liquidity. Now, people that the big players that are going to sell, the algo will always manipulate to take out the money to induce the movement, right? We learned about inducement in a bit, and we still see that in liquidity, because inducement is a type of liquidity, right? So first of all, this is what is going to happen before they move. So all the people with their stop losses here, they are going to be cleared out before price will move in the true direction that price wanted to move. So this equal levels now is what we call equal highs, right? Then also these are equal lows, and you have lows that are equal like this. So are equal lows. So the same thing happens, right? So for the case of equal lows, you have lows that are equal, price is equal, right? So what price will do is it's going to manipulate them out. Remember, we talked about the then move in the true direction, right? So all the people, all the stop losses, pending orders, everything will be triggered and taken out. So even for people that were thinking, breakout traders put pending order, sell pending order, that once price breaks this level, they should sell and their stop loss is somewhere, right? By the time price breaks, they will be happy, they're in profit. Then they'll be taken out in the opposing direction, right? So it seems like all the liquidity on both sides, both this side, are taken in the move. Do we understand? So that's equal high, right? If you go in your chart, you'll see this repeating itself. I'm going to look at them in the charts, and maybe let's do this way. So we do, as we explain it, we go to the chart and we look at it, right? So let's just briefly go to the chart and let's look. We're on the daily chart, right? Let's look at this concepts. Let's look at what I mean by that, by equal lows, right? You can see it here. You can see something here. Now, can you see this point? Now, okay, first let's finish. So we have next we have relative, sorry, what's the next one? We have relative equal highs and relative equal lows. Now, what that means, so I explain it. Relative equal high means that it's not equal, but it's a bit equal, right? That's why it's called relative equal high or relative equal low. Now, I'll explain it with in the diagrams. Now, if you look at this diagram here, if you look at price movement here, you see this. We can consider this a relative equal low, right? And you see at this point here, please, are you guys still with me?
Yes, sir. Yeah.
Yes,
Okay,
sir.
okay. So
Yes, sir.
this price points here, this is like a relative equal. They are not equal, but they are relatively equal, right? So you see here, this is what is going to happen because this is on the daily time frame. Now, support resistance, we'll call this that this is support because at this point, price didn't break below here, it went up. When it came down again, it didn't break below, it went up. So they'll consider this a valid point where they will buy and put their stop losses. And now that's liquidity. Although we are still bullish in the trend, but the algorithm is programmed to always seek the place of least liquidity to take out the liquidity, right? So you can see that's what happened by the move here, right? Price came down, took out liquidity, then continued in the right side. So you can see that that's one example. I'll show you. They are littered everywhere in the chart. You see them. That's the case of relative equal low. Now you can let's move. You see where you will find equal high. Find equal highs, equal lows. Right? This too can be. This is also relative equal high. Right? This relative equal high. Can you see these highs? They are relatively equal. See what price do manipulate. There are many places in the market. See, this is an equal low here. Can you see the manipulation that took place to take out that liquidity? So this repeats itself over and over in the marketplace now because the market will always, like I told you guys, the market is programmed to do one thing. Let me say it primarily one thing, that's to seek out liquidity, right? So seeking out liquidity is to seek out external range liquidity back to internal range liquidity. So I'm just explaining external right now. I'm going to go to internal, then I'll explain it. So I just want to show you the equal highs, the equal lows. You will see them. It's shown. You will see them littered. I'm just seeing multiple examples here. See, you can see this too. So you train at this equal high taken out before the move, right? Equal high taken out before the sell move continues. It's littered everywhere in the market. Relative equal lows taken out. You see it there. Sorry. Taken out. Can you see that? So it's littered. You can see littered everywhere in the marketplace. You see this liquidity point, external range liquidity. See here, can you see this? Equal lows taken out before the true move. So we find these are examples of relative equal highs and relative equal lows. So now for the people that maybe have this, what we call, the people call it double tops, double bottoms, and co, right? Sorry, there's a double tops, you have the double bottoms, triple tops, triple bottoms. These are liquidity points. All these are liquidity points, right? So now if you see from what we showed in chart here, now this is what plays out most of the time. This is what plays out most of the times. You see, like price is going like this, price is going up on an uptrend, then price now creates liquidity point to induce people, right, to think that price wants to start going up, right? So now you have sellers there, you come here, you have another sellers, then what happens? Price will take out these people, then continue to the upside, right? So you see price created equal lows took out the equal lows, took out the people that, okay, now you have sellers here. There'll be sellers at this point. From here, there'll be sellers here, sellers here, sellers here, sellers here, thinking that are not patient. Then price will take all of them out as liquidity to induce the current move we are moving in. Do we all understand? Right, this is another example too. So you have to get into the charts to train your eyes to say these are other examples of relative equal high, right? At this point where market was showing, it was building liquidity. This is what we call liquidity. Now you can see it was building liquidity on both sides, right? Building liquidity on both sides. So we have people think, okay, it's time to go down. Market takes them out first before truly going down, right? So now I think that should explain uh that should explain our external range liquidity, right? Do you have any questions?
Yes, sir.
Okay, let me hear you.
Okay, sir. For this list liquidity, how do we, if I want to enter a market now, how do I know that the market is about to, that is the market is done with clearing out all the first people that enter the market and it's about to reverse? That's my
Okay,
question.
now there are two things you combine. If I got your question right, there are two things you need to look at. Number one, that's why I'm teaching. If you see the way the modules are arranged, I'm teaching you step after step, right? So the first thing you pay attention to is structure, right? That's answering your question. The first thing you have to pay attention to, what is the structure of the market? Remember, have you gone through the class of market structure and advanced market structure?
Yes, I'm the one that marked. I've
Oh,
submitted my this.
okay, no, I just wanted to be sure that you have gone through the advanced market structure, right? So remember, we talk about inducement. Like I say, inducement is a form of liquidity. It's a form of liquidity also, right? So if you follow the structure in the marketplace, let me give you an example. Let's see if we find great example on the chart, right? Let's see if we find a good example on the chart. Oh, this is a perfect example. Let's look at this, right? So when you came into the marketplace, let's say you want to buy, right? Just ignore, don't just assume that this is a 1 minute chart. It's not even the daily chart. So let's just have that assumption, right? You are in the chart, you come and you are mapping your structure. If I map my structure at this point here, let's just map from this point here, right? So map from here, this is what we'll have. This is what we'll have. Let's see, this is the lowest point here. So we'll have this, right? Um, let's see. Then we have this, right? We have this, right? But before that, we had this point here, right? So do you remember the rule I told you for inducement? What's the rule for for inducement?
The market will take out all those people that the first people that enter the market.
Okay,
Market will
now
take them out, then it move.
let me just have, I think the first or the last pullback for the move, right, is most likely will be the inducement, right? So if we're marking out our structure, this is a perfect example. Let's look at this example here. Like you can see, right, based on the rule of market structure, this is a valid place, right? Do you understand why? Because there's pullback below this important candle. Remember the class. That's why I asked if you have gone through all the classes. This is a pullback here, right? This is a point, this is a point, this is a point, right? So if you look at this point here, where's the last higher low? The last higher low there will be this point. Do you agree with me? The last higher low will be this point. Do you agree with me? Based on our
Yes,
last
sir.
class.
Yes, sir.
Yes. So now, if you are a buyer, you will want to buy after this has been taken out, the inducement. That's how you know, right? every last, when market is moving in structure, it's moving like this, you are mapping your structure, then you came to price where price is here, you want to be a buyer, but you see that the last structural point formed, the last higher low, most likely will be inducement. Because if you want to buy, where will you buy from? You want to buy from a structural point, or you want to buy where you know that your stop loss is safe, right? So I'm just assuming that this is a lower time frame. Just assume that this is a lower time, maybe 5 minutes. So you want to buy. So you see there, this is this same diagram I put here. This is the same diagram represented by the price in this place. So this recent higher low will most likely be inducement, and you don't want to buy here because why? You are mapping from your structure, so you are waiting. The only time that you will know for sure is when, because you see this place, these points are very equal, so they are like the inducements there. So you'll be waiting for when price will take out those inducements to validate that, okay, we are continuing to the higher side. You can never tell. See, the market is never 100% um chance, it's probability. But this rule keeps you 60%, 70%, 80% right most times. Always waiting for the first structural point, which is like inducement, to be taken out. Then you know you are safe to buy. So after that is taken out, so it could either be with a candle closure, it could not be a candle closure, it doesn't matter, but you take it. So you will map your structure to that point. You are knowing now, before this inducement, the only valid structure point that we have will be this point, right? This will be the point I'll be looking at to change my bias, to let me know that, okay, I'm not buying again. The only time price will take out this point. Why? Because it was this impulsive, this higher low that impulsed to this upside, right? Because there was no structural point till this higher high. So this higher low here led to this higher high at this point here, right? The impulse. So for me not to be a buyer, this point has to be taken out. Do you understand? So, but I'm seeing other points higher than me. So I know that automatically, based on the rule, those points are inducement. Do you get the point?
Yes, sir.
So does that answer your question?
Yes, sir.
Okay. Okay, can we move further now?
Yes,
So
sir.
you see from the chart, right? So this explains our ERL, right? So basically, when we're talking about ERL, we're talking about old structural points, like so some people call them old highs, old lows. Those are external range liquidity. Now you must have you find them at structural points, which is what I explained here, right? So this will be, I can mark them, I can say external liquidities are this, right? But when I start explaining, you understand better when I go to internal range, right? So these are the external range liquidities because these are turning points, old lows, old highs. Right? You can also call them structural liquidity. Yeah? Some people call them structural liquidity, but I like to call them external range, right? So, like I said, price is programmed, or price is designed, or the algo is designed to do one thing. Primarily, it is designed to do one and one thing only. What is that thing? Is to seek out liquidity, right? So what price does is, right, I'm going into internal range liquidity now. So internal range liquidity is the liquidity within, inside of the structural leg of price, right? So if to explain internal range liquidity, right? I'm on two now. So let's look at this drawing. So now let's, okay, I've always been using uptrends. So you think it's only with uptrend. Let me use downtrend now. So let's imagine price was moving like this, like this, like this, right? So price is in the downtrend. Now, in a downtrend, for every time when price seeks internal, when price takes out external liquidity, price will seek internal liquidity. Now, let me explain. Now, for our downtrend, I said external liquidity are turning points, the highs or the lows, right? So I will mark for the downtrends. Let's mark our external liquidity, right? Right? So every time price takes out this, when this points is taken out, when external range liquidity is taken out, price will come inside and seek liquidity inside. Now, the liquidity within the structure of price inside, this is what is called internal range. You see, price will come and seek a point, liquidity inside this move to induce itself before continuing downwards. Do you understand? And one very popular internal range liquidity, you can call it, we call them imbalances. Imbalances or FVG, which is called fair value gap. Fair value gaps, right? Now, let me explain this. I hope I'm not rushing you, but just pay attention. You can go and rewatch the video, or if you have a question, you can ask. Now, at every point in price, there is something, there's liquidity, internal range liquidity, which I explained that either imbalances that has here that price normally seeks. When price takes out external, it will come to internal range. Then internal range will induce it to come back and take out external, right? When it takes out external, it will go back to internal range induce. So that's how price move. That's how price is designed. That's how the algo is designed to move in the marketplace. So the algo is designed to seek out liquidity in the marketplace from external to internal, from internal to external. So every time, that's what price does. Price seeks out liquidity, right? And remember, I said that you can put it in, you can say price seeks out liquidity and imbalance, or you can say price seeks out liquidity because the imbalance is also liquidity, right? I will explain the concept when we come to that point. But for now, just understand that there's something inside that price wants to seek, right? Internal range liquidity, which serves as a fair value gap or an imbalance that price will move. This is how price is designed to move. Price is designed to move from external liquidity to internal liquidity, always, always. And we can see it as depicted in the chart here. We can see the example in the chart here, right? So for the purpose of this class, I'll just brush through fair value gaps. Can you see? When price took out this liquidity, what? It came down for internal range liquidity. Now, what did I say? The primary internal range liquidity is what we call imbalances or fair value gap. Now, imbalances is where we have a gap in price. How do I explain this? But there's a model that we're going to talk about that, but understand it. Now, when price is moving, price has to be balanced when it's moving. That means that for every candle that forms, price has to rebalance every candle. Let's take, for instance, let's look at this three candle. Let's look at these three candles in view. These candles here, right? Let's look at these candles, 1, 2, 3, right? You can see that the high, when price moved here, the price moved rapidly from this place by creating 3 bullish candle. Now, this is what we call an impulse. Now, when it moved rapidly, there was no balancing of price. That means there were no sell candle, or the wicks of the top of the shadow of these candles didn't balance themselves out, as explained here. I think I have to draw a diagram for us to explain this. You might not really understand. Let me draw a diagram, right? When price is moving like this, price has to be balanced, right? This is when we say price is moving efficiently. Price has to move efficiently. So you either call imbalance or inefficiency, right? So if you see, this is a bullish candle, this another bullish, there are 3 fair value gaps, are 3 candle formation, right? With this movement here, we can say price is balanced. Why? Because by the close of this candle, the open of this candle came in between this candle, the range of the previous candle. So we can say price moved efficient. There's no gap in between. But when we have a case whereby we see price moves like this, we have a case whereby price moves, the first candle moves like this. Sorry. The first candle moves like this. Then let's say the wick of this candle. So imbalancing has to do with wicks, right? The next candle, Sorry, just give me. I'll be a little bit slow with this. Let's see this. Let's do like this. Hope I'm explaining this well. Hope we'll be able to understand this. Okay. Start a question. I sense. Okay. Now let's just use this. Okay. So we move. Okay. But I have a module that will explain this better. So it's just for you to just have a brief understanding, right? So these are three candles, right? So if we see here, this middle candle here did not balance with this down candle. You see, there's a gap between the wick of this candle and the other candle. Now, most of the time, this gap is wider, but I am explaining with a small gap so that you understand that it doesn't mean, right? So for price to balance, it means that the shadow of this candle must come into this other candle for price to move efficiently. So in this case, you see, in this three candle pattern, you see the upside here is balanced because this weak shadow came in between this candle, the range of the previous candle. So for this case, you see that price is not moving efficiently. I don't know, did someone raise their hands? Or I heard.
Yeah,
Okay, you have a
I just
question.
not really question. Just that the fair value gap. I just think if the gap between the high and low of the dead candle.
Exactly. You are right. So I'll just simplifying it. Maybe I'm looking for you to simplify it. Then I just so it's just a gap in between the shadows, right? Not really the high and low because this is the shadow high, the close, and the open of the shadow, right? So now that space in between shows that price is not moving efficiently in that way, right? So now that is the primary inefficiency in the marketplace, the fair value gap. Now, if you see from the chart we have here, now if price when price took out external, it came back towards to internal range. Now, if you look at this range of price, you will see there's the movement from up here created multiple, which is what we are going to learn in the press, we have multiple gaps, which is also called liquidity void, right? But price will also come in to seek out to rebalance by internal range liquidity. And if you see where price turned from here, price turned from what we call a gap here. There's a gap in price, right? So I think I'll call that. Let me just call that. So that's why it's called fair value gap. So there's a gap in price. You see, if I magnify this place, you see that there was a gap between the price delivery from this point, from the close, the high of this last candle, and the next low of this candle took off. So it was not balanced from here. So this middle candle is where the gap is created. So fair value gap is always a three candle pattern formation, right? Where there's a gap between the first and the last candle, while the middle candle is normally called the gap candle, right? So you see that price came deep into it. Can you see? Now that is internal range liquidity, right? Before continuing in the move. So the way the price is designed in the marketplace is to move from internal range to external and external to internal range. But we are going to understand these concepts better when we get into the model where I'm going to explain more about fair value gaps and we're going to look at them in detail. But for now, just get this general understanding of internal range liquidity. I hope it's understood, right?
Yes, sir.
Yes.
Okay. Okay. So next we have what I call time-based liquidity, right? So like the name imply, everything I've explained before now was based on price, right? So the liquidity was based on price when we have the equal highs, the equal lows, relative equal highs, relative equal lows, right? Going from external to internal range liquidity primarily being fair value gaps, right? I say primarily being fair value gaps. So because we can have there are other points that can serve as internal range liquidity that we are going to look into. We can the number one, you can have mitigation block or breaker blocks too. They can serve as a guide for internal range liquidity for price to move off after price takes out external range liquidity. So the next thing we're going to look at is the time-based liquidity. Now, time-based liquidity is divided primarily into what I put here, right? First of all, PMH, which is the previous month high, right? Previous month high. We have previous month low, right? But mostly because I'm a day trader, I mostly don't look at this except it aligns with one of these previous week's high or previous week's low, right? But I'm not always looking at the chart to see previous months, right? But for people that will be swing trading and position trading, you need to consider that also, right? But I'm also looking at previous week's high, right? PWH, that's previous week's high. Then previous week's low, that's PWL, right? Then PDH, previous day's high and previous day's low, right? Then we have the session highs and session low. Now, within the session high and session low, we have what we call the launch liquidity, which is liquidity for intraday traders, people that trade day trade. We call it launch liquidity. I don't think we might be able to complete this in this class, but let's just see where we stop before our time is up, right? So previous months high and low, we are looking at the turning point, the structural point, or the old highs or the old lows on our monthly time frame, right? So if you look at your chart, you'll see the last turning point for price, right? Because you see, like this place, this was a serious liquidity point, right? Because there were traders. If you look at this point here, right? This is one, right? We are looking at the turning point of on the monthly chart. That's one way of looking at it. I'll tell you the other way at this point. So these are liquidity points, right, on the monthly chart. Then also the way I look at it, personal, like I'm looking at the previous monthly candle. Sorry, right? We're looking at the high and lows of the monthly candle. Now, this is the monthly candle. So we are looking at the highs. Let's zoom in. So sorry, this is going to affect us. Let me just push it to the side a bit. So we're looking at the monthly chart, right? So we're looking at the monthly candle formation, the high and the low of the previous month one. So now this particular candle we are right now, this is what this is our current month. This is the October candle, this bearish candle here. This is the October candle, right? So this previous candle, which was our September candle, we're looking at also the high and the low of this candle. There are also major liquidity points in which once price come into there will be major reaction, right? So that was the previous month's high or previous month's low, the way I look at it. Apart from the turning points, the major old lows and low old high on the monthly charts, then we look at the monthly candle. So this whole candle, now this is GBP USD. So for the whole month of September, it's safe to say that it was bullish. GU was bullish. So now, anytime price comes and takes out this previous month's candle, there will be a serious reaction because there's a lot of liquidity that is resting here. Why is liquidity resting here? Because maybe for large positions traders, right? For large position traders that probably traded were in a sell when price was going up here, their stop losses will be around those points. And if you see this candle and this other bearish candle also formed what we call relative equal high. If you look at that. So for now, for the purpose of this class, just understand that when price comes to those major liquidity points, there's reaction because price is going to take out liquidity and you see a reaction in the marketplace, right? So the next one we have, again, I said previous previous week's high, right? Same thing applies. The same analogy that I explained the previous month applies for previous week, right? We are looking at the turning points, the structural points on the weekly time frame. We go to the weekly time, we're looking at the structural points here. You are seeing them, structural point, and also you are looking at the high and the low of the previous week's candle. Are looking at the high and the low of previous week's candle. So there's going to be liquidity at this point. Now, it means that there's a lot of money resting at this point. So when liquidity is grabbed at this point, there will be a major reaction at this point. Do we understand? So the same concept applies for previous days high and low. The same concept I just explained applies for previous day high and low, right? Together on the daily time frame, you see, look at the major structural points on the daily time frame. Then you see the highs and the low of the previous candles, right? If you can understand this thing that liquidity rests here, you see there will always be reaction and there'll be there'll be very high probability trades at this point. Very, very high probability trades when these points of liquidity are being taken out, right? So it's safe to understand as I round off. I think we're going to continue in our subsequent class. Where was I? Where was I? Where was I? Okay, I think I moved it, so it's going to be on the weekly time frame. Okay, so if we look at this time-based liquidity, now the session highs and session lows, right? Session highs and session low basically are the highest point and the lowest point of price within a particular session. Remember, I taught you in the beginner class about sessions, when the session starts, right? So for instance, for London session starts 8 a.m. Nigerian time, right? So you look between 8 a.m. Nigerian time to when London close time, right? London close is around, okay, they're about before New York open. So between 6 a.m. or 6 a.m. in our time, around 12, 6, 7, yeah, around 11, 12. That's around London close. So you look at the highest point of price between those time zones. Liquidity is always resting there because there are some people that might enter for a sell. Let's take, for instance, right? I don't have an indicator, but there's an indicator that can do this easily for you. I don't use those session indicators because I understand the time, so I do it manually. But let's say let's go to the 15 minutes chart. I think we're going to end our next class. We're going to explain the launch liquidity. Then we'll go into other things in the next class. So let's look, for instance, let's look at today's price action, right? Let's look at London session today. So London started somewhere around here, around 3, right? London open, right? So let's say from here to so 6 thereabout. Okay, that's, yeah, right? So if you mark out this point, right? So the lowest point of price within this time zone, the lowest point of price within this time zone, you see as marked out in there. So this will represent the high, the London's highest price point will be represented here, and the lowest point for during London close will be represented here. So it means that liquidity is resting here, right? So now you can see for people that started selling pre-London, most of their stop losses will be above here. So anytime if price moved within the day and takes out this point, you see major reaction. So there's liquidity at this point. So mostly what the algo does, the algo will seek all those liquidities, just like it came down, right? When New York opened around here, right? People who thought that, okay, we are continuing to buy for this particular day, we're buying. That's what indicated by buying this candle close, right? The price also continue with the sell pressure by taking out all the stop losses for people that started buying at this point, thinking that this is the turning point of the market. Market is beginning to go up, right? So for now, just get the basic knowledge that there'll be major price reaction at this point, right? So for the launch liquidity is just indicated by time, just the same thing is what we call the launch, either during the Asian session, the launch during Asia, launch during London. Why? Because that's what I trade. I don't trade Asian sessions, so I don't concentrate on the New York launch, right? So I trade London and New York. So I'm focusing on the Asian launch where liquidity is resting, and I'm focusing also on where liquidity is resting during London launch to trade New York, right? I'm going to explain this further that give us time to ask questions before we call it a day. In the next class, then we'll go deeper into looking at what I call what do you call it again? What I call PDRA matrix. So we're going to look at two things from our next class. We're looking at PDRA matrix and we're looking at institutional reference points in our next class. So if you have questions, if you have your questions, sorry, this now is time to ask. Okay, Chuendo, you go first.
Thank you, sir. So, um, at the beginning of this class, you made mention of we not trading on the news. How do we know that there is news with the candles? I don't even know that thing. It used to confuse me.
Okay. I think that's one that was like one of the final module I put, but I'll just explain it. Right? There's what we call economic calendar for forex trading, right? It's available everywhere there, but the primary site that most 80% of forex traders look at is what we call forex factory. Forex factory. I think I'll just pull it up. Then I'll pull it up. Can you see what can you see my screen? I don't know if I'm
I can see Google.
You search bar.
Okay.
so you can see, right? So this is Forex Factory. You can all see my this thing, right? So for every week, you see these are
Yeah.
all the news. Now, what to pay attention is what we call red folder news. Red folder news. So if you are trading, you have to pay, and you see now this is how it shows. It shows you the news. What is it? A red folder news? What currency does it affect? To show you the currency it affects, right? So you'll be focusing on the pairs that you trade. So let's go to today, for instance. Today was Tuesday, right? So you see all these ones, the news, they are not important, right? They are not important. They're not important because they are not red folder. Now these are the important ones, right? From 10 a.m. Now, this is based on Nigerian time. I've set it based on my time zone, so you can set it based on your time zone, right? So euro. So if I was trading anything that has to do euro, euro is a little bit correlated. EU is a little bit correlated with GU. That means ERA USD is correlated with GBP USD. So you know during this time, you know that news is going to affect it. So if you are trading GU and you're trading EU, you are trading anything that has euro to it, you know that you should be careful by 10 a.m. So it shows you here, right? It's red folder. Now, these are the news that you should be wary of. You should not trade, right? So you see again by around 3 p.m. we had news that affected all USD currency. Any currency that has USD on it, it affected it. Can you see?
Yes, sir.
Yes. So this is how you know the news. So every day, now for what you do as a trader, or I'm explaining, but I'll say explaining what you do for every week. You go and look at the news, right? So it's even some traders don't even trade on days where there are no news because they feel that there's no volatility in the marketplace, right? Why? Because based on the fundamentals, market moves based on sentiment, price action, and the algo. But sometimes people will the algo is moving, but people's sentiments, people's perception to the algo will determine the rate to which they will put their orders in the market for the algo to manipulate with, right? So if let's take for instance this news is coming up and people feel that um, USD, that's US dollar, is going to be very strong, right? If US dollar is going to be very strong, if you are trading EU areas, that it tells you that you should be looking to sell, right? So everybody will be looking to sell, right? So they that time determines, because of that volatility of people wanting to place orders in the marketplace, the algo will manipulate more during that window, right? And this time of high manipulation and high volatility is very unpredictable. Yes, there are sometimes you can trade it and you smile to the bank, but it's not wise as a disciplined trader to trade news, right? Although some people live off trading news, but I will not advise it. So this is how you know. So for the whole week, you know all the news events that are going to affect all the currencies, right? As for tomorrow I know, right? There's a news by 1:15 p.m. Nigerian time. Then there's another major news again on Thursday by 1:30. So these are the news I'm looking, because I don't trade CHF. This is Swiss franc. So I'm not bothered about all these ones. So I'm looking at the ones that concerns USD related pairs. So this is what you should look at. Then there's another very dangerous news we call non NFP, um non-farm payroll. But I think this one, is it this not non-farm payroll, but it's a non-farm employment change. Yes, this is non-farm employment change, right? So 1:30 on Friday again. So this is how you know it. So the major website to go to is Forex Factory. So you can search it, you just see economic calendar. It shows you every week, you know, the news that are going to come up. I hope this answers your question.
Yes, sir.
Okay. Do you have any other person asking question? So please, we are moving step by step. Oh, sorry, Maranatha, you asked your question soon. We are moving step by step. So please, you see, there's one thing in learning. I can give you with from personal example. When you are learning something, you just want to jump and just say, okay, you just tell me, just give me the thing. How if I just press and I'll start making money? That's not the mindset to take when you're learning skill, right? That's one of the reasons till date I started learning how to play the piano. I never got to learn how to play because I just wanted the person teaching me. Don't just teach me quick, because when I started, he said started with the basics, telling me, okay, press do re mi fa. I was like, just tell me how to play a full song. Until today, I don't know how to play the piano. So please, everything we have been going through, all the previous lessons, those concepts, put them, like I always say, put them at the back of your brain or at the back of your jeans pocket, because by the time we start putting everything together, you will see that it fits perfectly. Everything is important, right? And I know I spent more time on structure because that's way important. So Maranta, you can ask your question.
All right, sir. So for the liquidity concept, if I got it correctly, now the aim of this
Yes.
knowledge is just to like you define liquidity to tell where the money is resting at, to both avoid the liquidity and also take advantage of the liquidity, right?
Exactly. So that you are not liquidity. Now, if you know the slogan of my company is don't be the liquidity, right? So the goal is for you not to be the liquidity, but to take advantage of the liquidity.
All right, sir.
Yes. Okay. And do we have any other questions? Okay, guys. Thank Chwendu, you want to speak? I have a question.
Yes, sir. Sorry for the many questions.
I can't hear you.